Kieran, 2018 was a difficult year for UK equity markets. What were the main drivers behind that, and how did your portfolios perform against that backdrop?
Yes, 2018 was a very difficult year. In fact, the fifth worst year in 40 years. Extraordinary, really. And that was for quite a few reasons, whether it was US politics and trade wars, rising interest rates in the US, which in effect sets the cost of capital for a lot of the world, and higher rates, generally bad for prices and values of other assets around the world. Also slowing economic growth in large parts of the world, Europe, UK, and even in North America. And that's quite a challenging backdrop for equity markets, and they were duly quite weak, and the UK in particular because of political uncertainty, whether it's a minority government, but also dealing with Brexit. The portfolios I manage did a little bit better than the market, and for my investment trust, I had taken the gearing down to around about zero. And gearing is something, where you borrow a bit of money to invest, which is one of the features of an investment trust, which if markets are going up, which they generally do over a long period of time, that's to the benefit of shareholders, but if markets fall, that's to the disbenefit. And so not having gearing was also beneficial actually over the course of the year.
So a tricky year in 2018. Is there room for sort of more optimism as we move into 2019?
It's never clear what's going to happen in any year, actually, but this year certainly appears to be foggier than usual, and part of that is that we've got no resolution yet to the political environment in the UK, and the US trade spats are continuing and frankly likely to continue, irrespective of whether deals are for a moment in time are achieved with China. But investing in equities, I think, is the world of the optimist. All the value in companies is in the future, not in today. And I still think there is room to find businesses where there's something a bit special about them. They're doing something a little bit different, or they're doing it better than its competitors, and they're making good returns, and they're doing the right things for shareholders, and they're run by the right kind of people. And they're positioned to do well in good environments, but actually do okay even in difficult environments, and I'm hoping to find those kinds of businesses. So I remain optimistic, and also a weak stock market can often throw up interesting opportunities. So I'm quite optimistic that I'll find some good quality businesses where the headwinds and the poor environment have made the share prices quite attractive.
Unfortunately, no discussion on UK equities can avoid discussing Brexit. How's that impacting what you're doing in portfolios?
I am trying to not make the success of this portfolio depend on me having an absolutely accurate view on what Brexit means, exactly how it plays out and when it plays out. Anybody watching this will probably share my bewilderment at the constant shifting, changing options and possibilities of what could come next. It really, I don't think, is the right thing to take a strong view about what will happen with Brexit and to position a portfolio for that one view of what will happen, because that seems quite risky to me. So I am trying to find businesses which are well prepared for eventualities, so hopefully any untoward outcomes aren't damaging to the companies in the portfolios. Also trying to find businesses where they continue to have good opportunities in front of them and they're able to make the most of those, and where Brexit doesn't actually matter too much to them.
You've highlighted a number of macro headwinds and the fact that they may not dissipate anytime soon. As a stock picker, how much does a macro backdrop influence your portfolio positioning?
You can't get away from the backdrop and seeing a slower economic environment, for example. However, I don't make it the centerpiece of my approach, and it's partly that we can all look at where the economy has come from, Those are essentially facts, even if they get adjusted a little bit over time. But looking forward, forecasts of economic progress, in my experience, aren't very reliable. So I don't try to pin my investment approach on people's forecasts of the future for the economy. I spend most of my time looking at the particularities of the companies that are in front of me and who runs them and what they do and how they do it and how well they do it and what you have to pay for the shares currently, and that's the main focus of mine.
So the utility sector is domestically exposed sector, clearly influenced by political backdrop, what's happening on Brexit as well. Why do you find that sector attractive currently?
At the heart of the regulated utility businesses, which the bulk of what's in the portfolio, are businesses where the regulator requires a certain amount of outcomes based on investments in the infrastructure, whether it's water pipes or gas pipes or electricity wires, and allows the companies that do that well to reward their shareholders. And so the outcome for shareholders in the past for investing in this sector has been one of steadily seeing capital growth because of the growth in the assets in which they invest, and also as part of this pact with the regulator that they can reward shareholders if they manage themselves efficiently. It's also shown an attractive level of dividend and a dividend which grows over time. And so for my portfolios, for a part of the portfolio, it's quite an attractive set of companies because that combination of growing assets and the potential for dividend growth.
And finally, Kieran, what message would you like to leave investors with?
I'd say that it's very easy to feel worried when the headlines in the newspapers are very negative and when share prices have been very weak. But thinking about it a different way, valuations, because of the share price weakness, are more attractive. And also, dividend yields are higher because of that. So the level of income available from investing in the market is quite attractive. In Invesco Income Growth, the yield's relatively attractive and also has got 21 years of growth behind it. And because it's an investment trust company with dividend reserves, which are built up when times are good, even if we're into a period when perhaps there's lower dividend growth, there is that stability behind the dividend because the board has always got the option, as it has in the past, to use those reserves to smooth the dividend returns to shareholders.
Kieran, thank you very much.